Wall Street might actually have figured out, or at least some of the folks on Wall Street might have finally figured out why retail investors and some institutional investors are quite bullish on Tesla. Now, not only Wall Street, but even Tesla's, let's call it, competitors are figuring out that what Elon Musk has said a couple of years ago, which was deemed quite crazy, might actually be the way forward. What do I mean? Well, have a listen.
What we're going to explain to you today is that LiDAR is a fool's errand, and anyone relying on LiDAR is doomed.
Which has led us to this announcement yesterday. Mobileye has chosen to end the internal development of next-generation frequency-modulated continuous wave LiDARs for use in autonomous and highly automated driving systems. As part of our regular review of the long-term technology roadmap, we now believe that the availability of the next-generation FMCW LiDAR is less essential to our roadmap for eyes-off systems. This decision was based on a variety of factors, including substantial progress on our IQ6-based computer vision perception, increased clarity on the performance of our internally developed imaging radar, and continued better than expected cost reductions in third-party time-of-flight LiDAR units. So, better late than never. In other news, we also have something that I semi-predicted. I talked about the fact that Uber will not be destroyed by Tesla's robotaxi network on Finance Junkie's channel twice already. So this basically came out a few minutes before I started filming. Tesla and Uber have launched an in-car integration of ride-sharing navigation directly into Tesla vehicles for Uber drivers. And it makes sense. I know, it might be a battle between Uber, Tesla, Waymo, Cruise in the future, maybe some Chinese companies as well. And the cost of operating such a thing will be very, very low. So, well, the margins will be quite thin. So maybe you want to be the main operator of it all. But I think that Uber is perfectly positioned. Why is that? I'll explain. I think Uber, the platform, is the go-to thing, right? Just like Google is the go-to thing for search, just Google it. Airbnb, if you want to travel, that's the thing. Tesla, if we think about EVs, it's probably going to be Tesla, right? Uber is probably the number one thing you think about when you want to, well, get a so-called taxi, right? Or a ride somewhere. So they have that advantage. They've got the users, they've got the platform ready, right, for distribution. So why wouldn't other companies, right? We've already seen Cruise, maybe Waymo in the future, who knows? Maybe, I think we already know they're working with BYD as well. But why not? Why not partner with Uber, for example? They've got the platform, they've got the distribution, they know how to handle the millions and millions of payments each and every day, each and every hour, actually. So why not? I don't see how Uber will go out of business. They don't only do Uber, by the way, it's Uber Eats as well. They've got advertising. So being the platform, being the infrastructure for such a thing is a huge, huge advantage. Now, building the cars, operating those types of things is, of course, costing you way more money. And if the cost of riding a robo-taxi is what, 20 cents, 25 cents or something like that, then I'd rather be the distribution channel, right? The app, higher margins with advertising and stuff like that. So yeah, it's a no-brainer in my opinion. It's great for Uber drivers, for Tesla drivers as well. And in the future, I think we'll see more and more of those partnerships. So no, I'm not in the camp of, oh, Tesla's robotaxi will just destroy Uber. I don't think so. But maybe I'll be wrong. Maybe. Just prove me wrong in the comments if you have any counter arguments. Maybe we'll do a special video just about that in the future. Anyways, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We'll really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment. Get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So we've got a series of analyst commentary in this video. We first start with, of course, Morgan Stanley. This was from last week. So what's up with Tesla? 4 PT thoughts. Tesla remains our top pick in US autos as the company continues to take steps to mitigate down risk to the core auto business, which is around $59 per share for them, while shifting incremental resources to stationary energy, compute infrastructure, and robotics and other expressions of embodied AI. Now, I know not everyone sees these types of things, these notes, so I'll just read the important points here. So number one, Tesla's underperformance. Nearly 50% off of its all-time highs, Tesla has significantly underperformed its mega cap tech cohort for the past 3 years. A nearly 50% drop in consensus estimates over the past year may go some way to explain this, which you can see right here. You can see we're down here for calendar year 2024. EPS estimate is down 50%, and calendar year 2025 is actually down already 45%. Point number two, is Tesla profitable in the core auto business? We forecast Tesla fiscal year 2024 GAAP operating profit to come at $5.6 billion. I'll show you a couple of graphs later, charts later on in this video. When backing out our forecast for ZEV credits, $2.3 billion, and our estimate of Tesla Energy, $1.1 billion, reduces the core auto OP number to $2.2 billion. While not disclosed by the company, we can easily account for 100% of this remainder with captive dealer margins and range of recurring revenue streams, including connectivity, charging, software services, upgrades, FSD, etc., implying remaining operations, mostly EVs, to be loss-making this year. Again, this is for fiscal year 2024. In our view, this may not be a draconian assumption given capacity utilization near the 70% level and continued competitive pressure. We know that a large portion of Tesla's OPEX burden is non-auto, including AI infrastructure, which this algebraic exercise does not adjust for. I'll show you, again, later in this video some charts with capital expenditures, free cash flow and stuff like that. Point 3 is about the Robotaxi Day in Hollywood. While we are bullish on the very long term of potential for autonomous vehicles to transform surface transport networks, we urge our clients to keep expectations well managed for the near term. I can 100% agree on that. And number 4, a few other things. Elon Musk said the delay in timing for the original Robotaxi event was meant to give the company extra time to show off a few other things. Could we see an electric plane, a boat, the latest generation Optimus robot flipping burgers at a Tesla diner? We're not really sure. We remind investors that such events aim to achieve multiple purposes, including recruiting, marketing, and consumer education. To be honest, I think the other extra things might maybe be a cyber van, a Tesla van, and hopefully we do get to see Optimus robot, the next generation one. That could be quite cool. Now, with regards to that Robotaxi Day in Hollywood, Green the Only here posted on X this map, basically Tesla collecting quite a lot of data surrounding the Warner Brothers studios. So yeah, I do expect to see a real demo, not a demo on a screen, but a real demo. And yes, you might say, oh, but that's probably going to be geofence or something like that. Okay, maybe, but I rather see a geofenced real life demo than a fake one on the screen or one that will not work and, well, create quite negative headlines. So yeah, we'll see what happens. We also saw Elon Musk next to the Warner Brothers Studios CEO at the US Open, and I believe also next to the Activision one. So yeah, quite cool. Moving on to the next one, also Morgan Stanley here. So yeah, these are basically blog posts, but I like them. So this is what he said. This is also coming after the Wall Street Journal reported on a story of how Tesla and Elon Musk AI startup XAI have discussed potential licensing revenue sharing opportunities, although Elon Musk responded via X, sharing the summary of the article was not accurate. By the way, saying not accurate does not mean that everything is false. We've seen that play out before. So, some thoughts here. AI is bigger than EV. A recent investor survey suggested that the AI team is more deterministic to Tesla's share price than EVs by roughly 2 to 1. In our view, this makes commercial, scientific, economic developments around Elon Musk's privately held pure-play AI startup relevant. EV fundamentals can drive downside, but AI-adjacent developments are necessary to drive material upside in our view. We made Tesla our top pick, as we've discussed before. Car and human-shaped robots have clear overlap with LLMs. The advancements of large language models and generative AI have made a great leap into the field of robotics, accelerating how physical machines learn through natural language, imitation, simulation. As more auto companies embed smart AI assistants into the vehicles, investors can ask which technology Tesla will ultimately choose. Probably Grok, right? But maybe they'll open up to others as well. But I doubt it. Networks and collateral. We note that the value of Elon Musk's non-Tesla stakes may be reaching parity, exceeding the value of his Tesla shares, we urge Tesla investors to expand their analysis of the company's operational and strategic outlook to include scenarios that may potentially involve Mr. Musk's other interests outside the company. The last one here, autonomous industrial complex, we've talked about that actually. While there is significant attention ahead of Tesla's October 10th, which is by the way a month from today, we see the interaction of robotics and autonomy having far broader potential relevance across a wide spectrum of machines and devices in embodied AI. He then, of course, talks here about the Muskonomy. So you've got Tesla in the middle, then you've got Optimus, FSD, batteries, X, the Boring Company, SpaceX, xAI, and Neuralink. Of course, we as Tesla shareholders, we hope that if future partnerships get made, right, with SpaceX, with xAI, whatever, that we finally get paid, right? That we're not going to be the piggy bank for other companies, for other investments. Because I've seen this story play out before, right? Selling Tesla shares to fund something else, or using Tesla resources, for example, to help the other companies. I'm fine with that in the beginning, but eventually, when you make those promises, right, if Starlink goes public, then Tesla shareholders would benefit from that, or xAI should have, or Tesla shareholders should have share in xAI. Well, I'll believe it when I see it. Last note here, and that's another positive one that comes from Deutsche Bank, has named Tesla as top pick with a $295 price target. At the core, we do not see Tesla as an automaker, but rather a technology platform attempting to reshape multiple industries, deserving of a unique type of valuation framework. Tesla structurally already has a big lead in BEVs, especially as it relates to scale and cost, and commands outsized brand value globally. Near-term automotive deliveries and margin have indeed been softer, but we view this as a temporary ahead of new models refreshes coming in the pipeline. Long-term, Tesla is an emerging leader in autonomous driving and humanoid robots, in our view, which represents some of the most clear and lucrative applications of end-to-end AI. Furthermore, the energy storage business is already undergoing a major growth margin inflection, set to generate around over $13 billion in sales in 2025. And so we have now promises or near-term catalysts, should I say, from Tesla AI on X. Due to popular demand, Tesla AI team released the following roadmap. In September, you're going to see, probably seen already, various updates for the FSD, actually Smart Summon, Cybertruck Auto Park, eye tracking with sunglasses, end-to-end network on highways, and Cybertruck FSD. In October, of course, we have the Robotaxi event. You'll get Unpark, Park, and Reverse in FSD. You also might have the version 13 with around 6x improved miles between necessary intervention. Hopefully they finally will release public data, because we've been hearing about these things for quite a while. So why not release it black on white so we can all see the real improvements? Because until they really release the numbers, it's quite difficult to really believe what they're saying here, right? In September, version 12.5.2 with around 3x improved miles between necessary intervention, and then version 13 with around 6x. So if you're putting these numbers here in a tweet, why not provide the data? I don't know, that's just me maybe. Anyways, moving on, in Q1 2025, FSD in Europe, FSD in China, of course pending regulatory approval. And so, going back to what I said before and what the analysts were saying before, looking at the energy side of the business, and also, by the way, the services one, because services is also going to grow as Tesla grows, as they sell more and more vehicles. Services is expected to grow, revenue and gross profit. Tesla Energy, again, this is a great business to have. And as you can see, this is the blue line. Last quarter, basically almost doubled quarter over quarter. Huge explosion there. High margin business as well. This is definitely going to help, especially in the near term, if there is continued EV weakness. And until we get new refresh models and new models, next generation vehicles overall, these parts of the business, of course, smaller than the automotive ones, but very helpful, very profitable for the company. Because yes, right now, in the short run, automotive side of the business is still the biggest one, and it's basically the most important one in the short run, especially for Wall Street. We've seen revenue go up throughout the years, although in the last couple of quarters, revenue has been flat to down, but automotive gross profit has been coming down for quite a while. That has been a problem, of course, and that's why margins have come down. And now, last thing here is, of course, free cash flow. So free cash flow, this is in the last 12 months, by the way. It peaked here Q2, Q3 of 2022. Then, of course, prices of the vehicles came down, margins came down, sentiment is down, the economy is down, everything's down, so free cash flow has come down heavily. But what you can also see is that capital expenditures have continued to increase year after year, quarter after quarter. So the moment they basically go back to the usual number, right? 6, 7, $8 billion, that will have a very, very positive impact on the profitability side of the business. Right now, they're investing a lot in AI infrastructure, their next generation vehicles, ramping up production, building new factories. So yeah, this is basically normal. But yeah, there will come a point where CapEx will be flat, will stay flat for a while. It won't go back to $2.5 billion, I doubt it, but it's not going to stay near $10 billion for many, many years. So yeah, I think we might be seeing a shift in sentiment towards Tesla, especially also since China is doing much, much better than expected. Europe is the exact opposite, as we've discussed in, I think, yesterday's videos or 2 days ago. For me, that's going to be in top right corner. Plus the weekly registrations for the week. Again, great numbers. We'll discuss that on Saturday, but year to date, we are finally up. We're finally year to date in the positive, and I expect that to increase in the coming weeks as well. But overall, I mean, for Tesla, like I've said before, it's really what comes next. Show me what you've got, what comes next, because that will be the most exciting times. That's about it for me in this video. Hopefully you enjoyed it. Like, comment, subscribe, do all of that, and I'll see you all in the next one. Bye bye.